Hi everyone, today my topic is BEAT. I will give a general introduction of this topic and will provide a case study in the end. BEAT is the abbreviation of Base Erosion and Anti-Abuse Tax from IRC Section 59A. It was invented from the TCJA of 2017. The objective was to make U.S. corporations more competitive internationally and to prevent erosion of U.S. tax base. Now the US government did reduce the tax for the corporation, but what they try to do is also to prevent the erosion of US tax base. And this is what GILTI and BEAT did. BEAT is the second provision to combat the base erosion after GILTI. The purpose of GILTI is to focus on the income part, and the purpose of BEAT is to focus on the expense part. BEAT is a new tax that is intended to apply to companies that significantly reduce their U.S. tax liability by making payments to foreign affiliates like foreign parents, foreign subsidiary, or foreign branch. The BEAT applies to an applicable taxpayer, which is any taxpayer that is a corporation other than RIC, REIT, or an S corporation, has an average annual gross receipts of at least 500 million over the three preceding taxable years, and has a base erosion percentage for the taxable year of at least 3%. 2% is for certain banks and security dealers. For consolidated group, applicable taxpayer is determined by reference to the gross receipts and the base erosion percentage of the aggregate group. An aggregate group generally means all members of a controlled group, but it excludes counting foreign corporations' income because those income are not subject to U.S. tax. To calculate BEAT liability, the first thing is to know what is base erosion payment. The payment is to a related foreign party and it includes um, royalty payments, management fees, interest payments, amount paid or accrued to a related foreign party in connection with acquisition of property that is depreciable or amortizable, and reinsurance premiums. The key here is royalties and management fees. Cost of goods sold are treated as reduction in gross receipts rather than a deduction from gross income, so they are generally not considered base erosion payment. How to calculate BEAT? It is basically using A minus B here. A is adjusted regular tax liability. B is 10% modified taxable income. Adjusted regular tax liability is equal to regular pre-credit tax liability minus generally all credits except Section 41 research credit and a certain portion of the low-income housing credit, the renewable energy production credit, and the energy investment credit. Modified taxable income most of the time is equal to company's income plus base erosion payment. Here are some updates. Starting in 2026, the rate on modified taxable income increased to 12.5% from 10%, and regular pre-credit tax liability is reduced by generally all credits, including the specific credit described in the previous slide, for purpose of BEAT calculation. Here is a case study. For example, in 2021, Corporation C is a C corporation and a U.S. taxpayer generates revenue of 900 million in the United States and incurs tax deductible expense of 800 million, resulting in U.S. source taxable income of 100 million. Assume corporation C has a average annual gross receipts of 700 million in the preceding 3 years. Expenses include royalty and management fee payments made to foreign affiliates in the amount of 300 million. Step 1. Is the corporation C subject to a possible bid? The answer is yes. 700 million is the corporation's average annual gross receipts, which is more than 500 million. And also 300 million of the royalty fees, base erosion payment divided by 800 million, which is the tax deductible expense, is equal to 37.5%, which is more than 3%. Step 2 is to calculate the adjusted regular tax liability. You use the regular U.S. tax liability minus certain credits. In this case, there are no credits mentioned. So you will use 100 million times 21% U.S. tax rate. The amount is 21%. Step 3 is to calculate modified taxable income. It's basically using the U.S. source taxable income plus the base erosion payment of 300 million, which is equal to 400 million. 400 million times 10% is equal to 40 million. Lastly, to determine the bid owed, 40 million is more than 21 million, so 40 million is the U.S. tax liability, and the bid tax owed is 40 million minus 21 million, which is equal to 18 million.